Live from New York City this morning. Good morning, good morning. The CPI report is behind us. Chairman Powell still ahead. Your equity market just a touch softer on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Chair Powell gets a no-drama inflation report. Weak holiday sales are hitting Hasbro hard, and Ford delivers EV hopes a reality check. We begin with the big issue, inflation in America.
We have CPI data.
Inflation data.
Inflation numbers.
Inflation's been coming down very gradually.
We've seen inflation start to trend lower.
To slow down inflation.
I think all the factors that were there to bring inflation down, they're still there.
We still have a lot of disinflationary forces.
Underlying trends for inflation are extremely favorable.
All the way down to 2%. We think that's going to be a hard pull.
Kind of the easy disinflation is behind us.
We don't think the Fed is going to blink. Even if inflation does continue to slow.
The Fed needs to ensure that inflation is stamped out.
That's the big bet right now. Can the Fed afford to pull back?
What's the speed of that disinflation that they can live with, and what's still not fast enough?
We're going to have a Fed meeting that's critical.
We'll be looking at the Fed for clues at their meeting this week.
Let's have that conversation right now. JP Morgan's David Leibovitz, Crossmark's Victoria Fernandez. Fernandez, let's get to you first. Victoria, the CPI report of 31 minutes ago. Your thoughts on it?
Yeah, I don't think there was a big surprise in this report, except for some of the things that were maybe a little stickier than what people anticipated. You had the shelter number, which a lot of people thought was going to come down pretty significantly, actually moved up a little bit. Headline brought down, obviously, by gasoline prices, down 6%, so that pulled the headline down. But I think the key thing that Powell and the Fed is going to be watching is that core number did not move. We're still at 4%. So the market and investors that have that belief that inflation is going to continue to fall rapidly and that the Fed is therefore going to start cutting rates, I think this might be a little bit of an eye-opener to say, wait a minute, maybe we need to take a step back. Maybe we need to think that the Fed probably will be higher for longer, and I'll actually be looking for Powell tomorrow to push back a little bit on where the market is, where it's gotten a little bit ahead of itself. I think this inflation report feeds into that narrative.
David, let's go there. What's the risk we get stuck at 4?
So, when we look at what's happening in the core figures themselves, obviously headline was driven by what happened with gasoline. But, the BLS even said in the report that 70% of the core inflation that we're seeing is still attributable to housing. And so when we look at what's going on there, we look at some of the more timely measures, the Zillow measure, the Cleveland Fed measure. If you run some simple analysis and kind of use various leads and lags, it does suggest that shelter component should come off the boil over the course of the next few months. It's not going to happen instantaneously. That should help bring us down a bit further. But I do think that we still need to respect the fact that the last mile of the inflation journey is often the most difficult. And getting a Fed that's cutting in May does feel like a bit of a stretch from where I sit right now.
This is the constructive view. It comes from Neil Dutta of Renaissance Macro, just getting our teeth into the data. He says this: core inflation came in line with expectations despite a 1.6% increase in used car and truck prices. Goes on to say that's unlikely to persist in the coming months. There's room for downside on core inflation ahead. Victoria, would you push back against that?
I push back a little bit, even though I really like what Neil usually says. Not because I think that used car prices aren't going to come down. They probably will. They're actually quite volatile. We saw them down the month before. We saw them up this time. But I just think that it's going to be much tougher to take that core number lower at the pace that the market anticipates it's going to be. So I would push back on the idea that this core inflation is going to come down and that's going to be a green light for the Fed to go ahead and cut rates. There's a lot of elements in there, and we know that the housing market has been stuck a little bit. We've seen housing prices go higher, which is going to feed in to a higher shelter component, and we know that it's going to take a little bit of time for those numbers to start coming down. So I don't think that there's an imminent decrease in that number. I think we're going to have to wait quite a few months to see that, and that fits right into that higher for longer on the rates.
26 minutes away from the opening bout. Futures pulling in just a touch on the S&P. We're down about 0.1% on the S&P 500. Originally off the back of the move about 34 minutes ago, equities were a little bit higher. That's faded just since. Getting deeper into the inflation report, let's catch up with Mike McKee. Hey, Mike.
Hey, John. Well, this is basically a status quo inflation report. It is a little bit higher on the headline number, but the year-over-year numbers come down as anticipated, and the Fed is basically where it thought it would be, with a 3.1% headline rate and a 4% core rate. Housing, as you've mentioned, and used cars were the big customers for price increases. Decreasing gasoline, that really pushed things down, and apparel prices, a bit of a surprise. The super core, which Jay Powell had made his sort of favorite indicator, has kind of dropped off their list, and maybe that's good news, because we take out housing here and we still see core prices going up for the month by more than double what they had the prior month, and on a year-over-year basis up to 3.93%. It was in the twos before. And then we want to take a look at the breakdown overall of where prices have gone, and it's still services that we're worried about. You look at the ECAN function on the Bloomberg, our quant-driven analysis of what's happened in any economic indicator, and services, the yellow, is really the big mover here. Goods prices are the blue ones, and as you can see, they're up a little bit, but not a whole lot. And energy prices, obviously, significantly lower. So this is basically, as I said, an as-expected report. We're waiting for services to come down more, driven a lot by housing, but also there are other aspects of that core that the Fed's going to keep an eye on. It's been said, the last mile, John, is the hardest for them.
And that might be still ahead of us. Mike McKee, thank you, sir. Mike McKee on the latest inflation data. David Leibovitz, let's talk about it. The data's in. Chairman Powell is tomorrow. Where does it leave him in the committee?
So I think that the Fed is likely a bit uncomfortable with where the market is currently priced. And if you look at whether it's the super core measure or you isolate, restaurant prices and what's been happening there, you're still seeing things go up at a pace that I think makes the Fed uncomfortable. I think that the tone tomorrow is going to be more balanced than it's been in the past. I think that they're going to begin to view kind of the risks as being more two-sided, to use a bit of Fed speak. But I think that they're going to push back again against what the market is pricing, which is a cut, in the late spring and early summer. By our lights, the Fed is probably going to remain on hold at least until the third quarter of next year. And again, I think that they want to see more progress on core inflation and even that super core measure before they begin to signal easier policy, because we've seen this trade play out time and time again. The market gets a whiff that the Fed may ease, and all of a sudden financial conditions loosen. The Fed is trying to avoid that, and I think they're going to be very careful in their messaging to try to prevent it from happening again.
So, Victoria, let's say we get all of that. We get a hawkish hold from this Federal Reserve. This market is not listening. It's moved on. Any reason why it starts to listen tomorrow?
I'm not sure what it's going to take for the market to really listen to what Powell's saying. The message hasn't changed, but they're getting kind of this confirmation bias is what the market's doing. They have Waller saying, look, if inflation comes down, we can cut rates, and they grasp onto that, and they're really running with it. I think the dot plots could be something that helps push against the market. I mean, I anticipate that we'll probably see the year-end rate for 2024 come down maybe 50 basis points. It was at, 5.1, maybe it comes down to around 4.6. That's very different than where the market was pricing it about 4 or 5 weeks ago. It was at 4%. Now I think the market's pricing it around a 4.30. So maybe that starts to shift the market, but they have to come to terms with the belief that you can't have earnings expectations of 11%, revenue expectations of 5% growth, and still think the Fed is going to come in and cut by 100 or 125 basis points next year. They don't fit together. So at some point, the market's going to have to determine which one of those beliefs they no longer believe in.
Well, David, let's just say right now, I believe that we get 100 basis points plus of cuts next year, and then the Federal Reserve comes out and moves in my direction, doesn't go all the way, but moves in my direction and prices in 3, projects 3, implies 3 based on their 2024 median dot. Is that sufficient, David, to validate what's been priced over the last month?
So I think that if we get that type of messaging from the Fed, it at a minimum is moving in the direction that the market would like to see. One of the things that we've been talking about quite a bit with respect to Fed cuts and the cuts being priced into the market is, does the overall level of cuts priced in change, or does the timing of those cuts simply shift? And I think if we get a message from the Fed that the timing of those cuts is simply going to shift, but there is still, 3, maybe 4 cuts in the cards over, say, the course of the next 18 months, right? The market can deal with that, and I think it'll deal with that pretty well. What is going to give the market indigestion is if the Fed sends a hawkish signal that we aren't going to get those 3 to 4 cuts over the course of the next year to year and a half. And so I think again, the dot plot, that's a very good point that Victoria makes. Watching the dot plot is going to be key with respect to 2024, but also with respect to 2025.
Well, let's get beyond tomorrow and focus on the next 12 months. The calls coming in from Citi on the S&P 500, 5,100. Oppenheimer, they're going higher, 5,200 on the S&P 500 year-end next year. Victoria, we've had a massive move over the last month, and we're starting to see signs of improving breadth as well going into next year. Do you see reason to believe that the path of least resistance is still higher?
I think in the short term, Jonathan, yes, because of the things you mentioned. The breadth is there. We've seen the percentage of S&P stocks above their 200-day or above their 20-day moving averages. That's gone higher. You've seen small caps start to do a little bit better and participate. And you've seen that Magnificent Seven actually start to come back, which I think is positive for the market because it allows the equal weight to catch up. So I think in the short term, yes, because the seasonality works for you as well here too. But there are so many things that are telling us on a little bit longer term, the volatility is going to be there. I mean, Jonathan, look, you have things that typically have very high correlations, like the economic surprise index and discretionary versus staples ratio. Those are going in opposite directions right now, which is not typical. You have positioning. We were oversold. Now we're overbought. That can change. And I think you are going to have a repricing in the market where yields are going to go back higher as some of these early rate cuts are going to get priced out of the market. So for a short term, yes, I think you could be tactical and you can make some moves here. But I think as we look out into the first half of next year and the second half of next year, you have to be a little bit more cautious. I think that's when we're going to see some of the pullbacks come into play.
David, do you agree?
I would generally agree with that. I'd go back to the point I was making earlier about the number of cuts versus the timing. And I very much would expect that yields will back up as we get more clarity about when the Fed will or perhaps will not be hiking. But I do get the sense that equities may be able to take that in stride. I mean, the growth backdrop remains relatively supportive. Earnings estimates look fairly decent for next year. I would fade the consensus numbers a bit, but we're still getting kind of mid-single digits for S&P 500 earnings over the course of 2024. And I think as long as that growth narrative remains in play, equities can stomach higher interest rates. It's if we begin to see cracks in the labor market or in the economy more broadly that I think we'll see a meaningful pullback in risk. But would agree with the point on higher yields, maybe a little bit more constructive on equities looking forward.
More still to come in this conversation. David Leibovitz, Victoria Fernandez, about 20 minutes out from the opening bell. Equities negative by just 0.03%. Will Chairman Powell push back, and how will this market respond to it? We need to figure all of that out in the next 24 hours. Let's get you some movers going into the open. Here's Abby.
Beneath that fairly benign surface for stocks, John, we have some bigger movers beneath going to the downside, starting out with the shares of Oracle. The worst day since March of 2016, headed toward that worst day, down 9.5%. This, of course, is revenues of $12.94 billion. Missed estimates by about 1%. Cloud growth was disappointing at 25% versus 30% in the previous quarter. For a stock up 40% into the print, it just wasn't good enough. Airbnb down 2.6% as the stock is cut to an underweight at Barclays. A team of analysts there saying that short-term demand is slowing as competitive pressures stack up from hotels. And then finally, Alphabet heading to a second down day in a row. They lost their lawsuit filed by Epic Games. A San Francisco jury sided with Epic in less than 4 hours that Alphabet overstepped its powers relative to its App Store. Well, that's threatening $200 billion of App Store revenue in that duopoly with Apple.
Abby, thank you. More from Abigail around the opening bell. Coming up on this program, Hasbro cutting 20% of its workforce.
We have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace.
Corporate America tightening its belt ahead of the holidays. That conversation up next.
Fed can take responsibility for the improvement that we've seen on the demand side. Certainly not the supply side, not the good side of things, as you talk about the recalibration in the aftermath of reopening the global economy. But on the demand side, we have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace.
Slumping holiday sales leading to a second round of job cuts at Hasbro. The toy maker cutting close to 20% of its staff over the next 18 to 24 months. The quote from the CEO: "Market headwinds we anticipated have proven to be stronger and more persistent than planned." Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, we're talking about Hasbro here. It's the maker of Dungeons & Dragons, My Little Pony. I'm sure you're familiar. It's really been struggling post-pandemic. You're seeing those struggles continue now today. So these planned job cuts are going to take place over the next 18 to 24 months. They include 200 jobs that were left over from a previous round of job cuts. That's expected to cost $134 million or so up front and then save $100 million annually. And it comes after Hasbro lowered its outlook in October. And the reason given at the time was that softer toy market heading into the holidays. 2 months later, clearly that is still the case. Even still, you take a look at Wall Street at the sell side, it is sticking by Hasbro. This is a stock with 0 sell ratings and 10 buys. Morgan Stanley, which has an overweight rating, it wrote this morning that discussions with Hasbro management suggest that these job cuts are proactive in nature as the company maintains its focus on improving profitability. Meanwhile, you have Stifel also saying that things likely do not get a lot worse from here. But it's important to point out that this isn't a problem just for Hasbro. You take a look at rival toy maker Mattel. It's also had to contend with a weaker toy market. But then you think about the success of the Barbie movie over this past summer. Mattel is looking at 6% or so gains this year. You compare that to Hasbro, down about 20% in 2023, down another 3% or so this morning.
Brutal. Katie, thanks for the update. Just absolutely brutal. We're talking about a toy maker cutting almost 20% of the workforce 2 weeks before Christmas. David Leibovitz, Victoria Fernandez back with us for more. Victoria, let's talk about it. Is it a Hasbro problem or a consumer spending problem?
Well, it's an interesting question because you look at the report that Amazon put out after Black Friday, and toys was one of their largest selling sectors that they had. So you have to wonder, is it more related to the Hasbro toys themselves? But look, the consumer has pulled back. We know they've pulled back. We know they're being more cautious about their spending, even though they're still out there. I want to say it's only up about 3.5% year over year on spending on holiday, which is lower than the average. So I think it's going to be more of a Hasbro issue per se in the toy sector, but we know we're probably going to see more. Look, you had State Street lay off, 15,000 workers last week. We're going to start to see some of these chinks in the armor of the labor market, and that is where I think we'll actually start to see weakness flow through the economy. That's probably what the Fed is looking at. But I still think we'll have a decently strong holiday season on shopping.
David, which one is it? Is the consumer doing better than okay or falling off a cliff?
So I think that the consumer is hanging in there. I mean, I think that when you look at what's going on with job cuts, it's proactive. I mean, we saw this with tech in 2022. This is just a way of businesses defending their margins in an environment where pricing power is fading. And so, I don't really think that we're seeing meaningful cracks in the consumer. Yes, labor markets have cooled marginally, but we also just added 200,000 jobs in the month of November and saw the unemployment rate move lower to 3.7% with 4% plus wage growth. And so, to me, that's not necessarily a near-term recipe for weakness in the consumer. But I would agree with Victoria. I mean, this is going to be all about the jobs market as we look forward, and any significant cracks in the labor market are going to get the Fed to change their rhetoric relatively quickly.
So we haven't seen significant cracks yet, David, and it makes me wonder. We have seen big moves in the equity market. Breadth's improved. We've seen cyclical parts of equity start to do well. Airlines are on fire again going into the holiday period. Now, I just wonder whether you think that's a mistake or the right trade going into year end and beyond.
So I think that there's still some upside in risk assets. Obviously, seasonals are relatively favorable, and I could well see the equity market grind higher into the end of the year. I think at some point you're going to need to reconcile the level of interest rates with what's being priced in terms of Fed policy going forward. And to me, that maybe gives the equity market a bit of indigestion during the first few months of 2024. But we are relatively constructive on the outlook for risk assets from here. We don't see a recession coming next year. We see inflation continuing to trend lower. And historically, that's been a pretty decent environment for financial assets, particularly if the Fed is able to ease in the back half of 2024.
Victoria, I'll ask you the same question in a different way. The improvement in breadth we've seen over the last month, do you see reasons for that to continue?
I think it could continue if we continue to see the inflation come down, right? We've had this easing of financial conditions, and so that's going to be supportive of these companies. But a lot of it is depending on their pricing power, and we've been talking about that this morning, what that means to their margins. As inflation comes down, pricing power diminishes for these corporations. And if their costs aren't going down tremendously, those margins get squeezed. We're going to see that come through in the earnings. And it usually takes about 12 to 18 months after the Fed starts hiking rates that corporations feel the pain and then start laying off workers. So if we're just now getting to the point where we're starting to see that, that could ramp up and cause issues for earnings, for the labor market going forward. So I think we have to be cautious. As I said earlier, I think short term, you're good. You have some tactical moves you can make, and the trend is probably a little bit higher. But longer term and going into next year, I think you have to be a little bit cautious because of these warning signs that we're seeing.
I think you're both on a similar page. Victoria Fernandez, David Leibovitz, to the both of you. Thank you. Going into the opening bell about 8 minutes away. Equity futures pulling back just a little bit. On the S&P, we're down by 0.1%. Take the inflation data, largely in line. I say largely in line. At the front end of the yield curve, in the bond market, a 2-year higher by a single basis point. The yield there about 4.72 on a 10-year, down about a single basis point on a 10-year to 4.22. Coming up on this programme, the morning calls and later, dare to dream or fear a mild recession. FS Investments' Troy Gayeski seeing two potential scenarios for markets and the US economy. That conversation just around the corner. Stocks just a little lower. Let's get you some morning calls this morning. First up, Citi downgrading Macy's to sell, expecting its recent buyout offer to never materialise. Your second call from Morgan Stanley upgrading Sonos to overweight, pointing to new product launches and an attractive valuation. And finally, Barclays downgrading Airbnb to underweight, saying recent data points to slowing demand and mounting competition. That stock is negative by 3%. Coming up, Ford slashing EV production targets as Hasbro cuts 20% of its workforce. That conversation up next with Troy Gayeski of FS Investments. Your equity market slightly negative near session lows. We're down 0.1%. Your opening bell is up next. No drama from the CPI report, setting up Chairman Powell tomorrow. One question, does he push back against this monster rally we've seen over the last 2 months? Your equity market right now pulling back by 0.1% on the S&P 500 on a 6-week winning streak. If we make it 7, the longest weekly winning streak since November 2017. There's your opening bell. Switch on the board and get to the bond market. Yields look like this, going absolutely nowhere on a 10-year, 423.51 in the FX market. Dollar weaker through much of this morning through the bulk of G10, 107.84, 107.83-ish on the euro against the US dollar. That currency pair positive by 0.2%, and crude pulling back into the 60s, 69.30 on WTI. We're down about 2.8%. About 20 seconds into the session, equities pulling back just a little bit. We're down 0.1% on the S&P. The Nasdaq going almost nowhere on the Nasdaq this morning. One stock to watch going somewhere, Hasbro, in the wrong direction. The toy maker cutting close to 20% of its workforce due to slumping holiday sales. Abby has more. Hey, Abby.
Hey, John, it's interesting that the stock at this point is well off of its lows, down just about 1%. As you've been making the point all morning, it's not really a good sign that a toy maker is cutting the workforce by such a degree, about 20% or 1,100 workers over the next 18 to 24 months, 2 weeks before Christmas. And they are citing slumping demand for toys. This isn't completely a surprise, though. In the last quarter that they reported, they highlighted the weakness and the sluggishness. They reduced their gross margin guidance for the year to 13 to 13.5% from 16 to 20%. But it wasn't just a matter of profitability. Revenues also came in. They were down 10% year over year for the guidance. They brought that in relative to the year as well, saying that sales would drop about 15%. It's interesting, though, because we do have analysts defending this name, as Katie was pointing out earlier. Stifel is saying that the worst is likely over. Morgan Stanley saying that the cuts are proactive. The stock down 2%. I would note on that last quarter that was a miss and a guide down over 2 days. The stock did fall about 17%. So some of it priced in there. On the other hand, John, on the year into today, the stock down about 20%. There's a 5% short interest, which from quick analysis, it doesn't sound like a true kitchen sink moment if one needs to be had. Stay tuned on more for Hasbro.
Down 1.5%. Abby, thank you. Abby and Katie mentioned in that note from Stifel. Here's the call from them. Cutting the price target down to 64 following those layoffs. Here's the quote. Things probably don't get a lot worse from here, but given the seasonality of the business and another disappointing holiday, we find it increasingly difficult to justify paying a higher multiple, at least over the interim. That name is now down by about 2.4% and down hard from the highs of a few months ago. I want to turn to earnings season, sinking this morning. Oracle reporting weakening sales growth within its cloud computing business. Alex Semenova has this one. Morning, Alex.
Good morning, John. A second straight quarter of slowing growth for Oracle's cloud infrastructure business. That's fueling investor concerns that the company's expansion efforts are failing to gain ground in a competitive market. The stock was down as much as 9% in pre-market trading. That's the most since September. You can see shares moving lower into the open as well. Cloud revenue rose 25% to $4.8 billion in the period ended November 30th. That's slower than the 30% gain in the prior quarter. Now, Oracle had been focused on broadening its cloud infrastructure business to compete with the likes of Alphabet, Microsoft, and Amazon, but that initiative hit a bit of a speed bump back in September after a year of accelerating growth. Executives still remain bullish on the business. Chairman Larry Ellison said today, quote, the demand is, quote, over the moon, and Oracle will continue to accommodate that demand. It's going to build out 100 new cloud data centers as part of that effort. The reaction from Wall Street analysts was a little bit less upbeat, though. Morgan Stanley said that it's waiting for more upside to justify the valuation. Bloomberg Intelligence analysts flagged supply constraints. They said growth coming in below estimates was the result of a shortage in the availability of AI chips. That's something they don't see reversing anytime soon. The stock is still up 40% year to date, John.
It's down this morning. Alex, thank you. It's down by 9.6%. The move this morning, downbeat, that's for sure. Also watching shares of Alphabet. Google losing its antitrust court fight to Epic Games. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. Google, or Alphabet, the parent of Google, down 0.5 percentage point. Basically, the jury of 9 in San Francisco decided that the Google Play App Store does represent a monopoly based on anti-competitive practices by parent Alphabet. They reviewed a large body of documentary evidence, internal memos that looked at the dealings of how Google Play was grown and the Android operating system and identified specific practices. For example, a practice of sharing revenue from Google Play with mobile device makers in return for being the app store of choice on the home screen of any phone that uses Android as an operating system. Google inevitably and understandably are going to challenge this decision, which is different to the outcome of what happened in the Epic and Apple trial. What happens next is that the judge who presided over this case will have to decide whether or not to enforce a change of policy for Google to allow app distribution outside of Google Play and another means of payment outside of Google Play. Our colleagues at Bloomberg Intelligence estimate that if that were to be the case, there would be a headwind to growth of 1 to 2 percentage points, which is the tangible impact here. Overall, the download or app market across Google and Apple is $200 billion a year. So there's a lot at stake, although these legal proceedings have a number of avenues for challenge. And as we learned in the an Apple case which is being reviewed by the Supreme Court, we could see this play out for a number of months.
Ed, thank you. Look out for more coverage on this story with Ed Ludlow and Caroline Hyde on Bloomberg Technology in about 2 hours and 30 minutes. Let's stick with tech. Cathie Wood boosting her stake in Microsoft and Meta as Warren Buffett cuts his HP holdings by nearly 50%. Katie Greifeld has this. Hey, Katie.
Hey, John. Yeah, uneven appetite for tech here. Let's start with Cathie Wood buying Microsoft and Meta in the ARK Next Generation ETF. We're talking about pretty small numbers in dollar amounts, just over $3 million a piece for those shares. But this was the first time that ARK has bought Microsoft in 9 months, the first time that ARK has bought Meta in 5 months. So clearly some demand returning there. Can't exactly say the same for Berkshire Hathaway and HP. Berkshire has cut its holdings in the PC maker by nearly half over just the past couple months. That is according to a filing which shows that Berkshire is on track to be a seller of HP for a second straight quarter. Now, it has been a rocky time for the PC industry working its way out of a post-pandemic bust. HP has actually managed a 13% gain so far this year, but that pales in comparison to some of its rivals. And now you have Berkshire backing away as well.
Katie, thank you for the update there. About 7 minutes into the session, we're down about 0.25% on the S&P 500. On the Nasdaq, we're down about 0.1%. So many outlooks across Wall Street over the last couple of months. The crystal ball season looking out to 2024 and beyond. Troy Gajewski of FS Investments discussing his outlook for the year ahead, writing this: the scenarios for future economic activity really boil down to just two plausible outcomes. We stay in the dare to dream environment for multiple years, or we enter a mild recession at some point in the next 6 to 18 months. Troy, not helpful. Let's get straight to it. What's more plausible in your mind, one or the other?
Yeah, so I think, again, in an environment like this, you should practice some degree of humility and not pretend to have a crystal ball over precision. I think from a standpoint of dare to dream versus mild recession, on the margin, we'd still say mild recession, primarily because withholding tax growth has rolled over now for 3 quarters in a row, which tells you that gradually the consumer is weakening. And again, every classic recession indicator, whether it's bank underwriting standards, inverted yield curve, the pace and magnitude that the Fed has tightened at, the lagging effects of monetary policy would tell you on the margin, it's slightly above 50%, call it 50 to 60, and then dare to dreams roughly 40 to 50. And so the point there is you have to plan your asset allocation accordingly and lean into strategies that can benefit from higher front end rates and not to get too over your skis now in beta, given how high multiples are. And also in terms of duration, because we've had a massive snapback rally from 5% to now 4.2 and change.
Well, let's talk about your approach right now, currently, and how you expect it to evolve in the coming quarters.
Yeah, so look, I think it depends on the strategy. One of the things we're really excited about in private markets right now is middle market private equity. So if you think about where growth stocks are, and let's all say clearly that the Magnificent Six, maybe Tesla, maybe not, are wonderful companies, but they're trading at 32 times forward earnings. And in middle market private equity, typically you have much less leverage, which is very important because cost of leverage has gone up so much. You have cheaper pricing, and you have natural organic growth because you're only talking about growing these companies' EBITDAs from 10 to 30 million or 20 to 40 million over time. And you don't have the dramatic whipsaws that come with the multiple compression we had last year or the multiple expansion we had this year. So when you're thinking about ways to generate growth and attractive risk-adjusted returns, we really like middle market private equity with a heavy emphasis on secondaries because there's a huge overhang of institutional allocation to private equity. There's a need and a desire to lighten up, particularly on older vintage funds. And so you can swoop in and buy these at pretty significant discounts, sometimes as much as 30%, typically 10 to 20. And that the volume of that market's expanded from, sub 10 billion, 10 years ago to consistently over $100 billion now. So we think that's one of the few areas in markets right now where you can get growth-like outcomes without taking undue risk of further multiple compression or a mild recession.
Troy, we hear so much about entering private markets. We spent some time, a whole morning, in fact, with Apollo just a week ago and talked about the opportunities there. Troy, do you think we've seen the pain in private markets before we really get our hands around the opportunities that exist?
Yeah, that's a really good question, John. I think the nature of the way private credit liability structures are set up, and that, private credit tends to have very long liability structures. Private equity, even in evergreen democratized solutions, have longer liability schedules. There's never like a Minsky moment where you're forced to sell. or a deleveraging a moment or a solvency moment like we had with banks in the past. Clearly, in private credit, you're going to see defaults go up, but in a mild recession, they shouldn't go up dramatically. And in the meanwhile, you're earning a much higher base rate yield than anyone dreamed of, including myself 2.5 years ago. And if we stay in that dare to dream environment, then you don't have the natural decline in revenue and further EBITDA compression. Up until now, EBITDA has been very resilient. Obviously, free cash flow is down a bit because interest expense is up so substantially. But in the event that companies have liquidity issues, there's a huge war chest of private equity that's there to step in and provide a ballast. And in the meanwhile, we're really focused on extending credit to companies that are very robust. They're just having short-term, modest liquidity issues. And if they can get a bridge loan over a certain period of time, that can dramatically reduce the risk of bankruptcy going forward.
Troy, one thing that Mark Rowan talked about, and I wonder if you agree, is that the opportunities for alpha in public markets have diminished because of the proliferation of indexing to public markets, just say an index, the S&P 500. Troy, is that something you agree with?
Oh, yeah, 100%. I mean, look, there really hasn't been meaningful alpha in the equity part of the capital structure since before the GFC. The short rebate went away. And so much of it's because, we have roughly 40% fewer private companies now, or public companies, I should say, after Sarbanes-Oxley, and roughly 40% more private companies. You certainly have more alpha potential in the middle market than in mega cap buyout shops. But yeah, in terms of alpha, it's very difficult to add it in the equity part of the capital structure. And you think about this year as a classic example. I mean, the rest of the markets kind of lagged dramatically, and the Magnificent Seven have driven the entire return almost of the S&P up until recently. So unless you're overweight those companies significantly, or you're levered long, which by definition isn't alpha, very difficult to outperform a market cap weighted index in an environment like this. So we'd agree with that statement wholeheartedly.
Just want to squeeze one in. Just one more question, Troy. Just going into next week, into tomorrow rather, what would you look for from Chairman Powell after these inflation numbers?
Yeah, so look, I mean, you think about the labor market report, the NFP report, you think about today's inflation. The Fed should continue to articulate, like they've done recently, data dependent. We're in no rush to cut, right? The risks are symmetrical, but they're symmetrical. They're not dramatically skewed to the downside, as many of the bond permeables have been arguing for 18 months. So they should push back hard on cuts next year. The probability of a cut in March is almost non-existent, even June. I'd really be surprised if they cut by 100 basis points by the end of next year. I think the soonest we could see them cut is, Q3, maybe 25 then, 25 in Q4. But that will depend upon continued economic slowdown and improvement on inflation. And we all know the last mile on inflation's a lot higher. It's a lot harder to get core CPI from 3 to 2 than it is from 5 to 3.
Yep, without a doubt. Troy, thank you. Troy Gersky there of FS Investments. Troy, enjoy Christmas. Good to catch up, buddy, as always. About 13 or 14 minutes into the session, equities pulling back just a little bit. We're down a third of 1% on the S&P and on the Nasdaq as well. If you look across the yield curve right now, the 2-year out to the 30-year, yields up just a little bit, a basis point or two. On a 2-year, up 2 basis points to 473. On 10s, we are in and around 425. Coming up, what a story. Ford slashing its EV production plans.
We've seen prices come down in the electric segment much quicker than we expected. And the reason for that is that we're moving out of the early adopters who are willing to pay for higher prices.
Shares under pressure, a grim sign for the EV market. That conversation up next.
We've seen prices come down in the electric segment much quicker than we expected. And the reason for that is that we're moving out of the early adopters who are willing to pay for higher prices. Early majority customers aren't. They're not willing to pay that premium. The adoption rate, it's flatter than what we had expected. The increase isn't as great. 50% up this year from a sales standpoint. So they're coming. It's going to be part of the industry. Eventually we'll get to those higher growth rates.
That was the Ford CFO, John Lawler, weighing in on EVs and the consumer weeks ahead of the company slashing its 2024 production goals for the electric F-150 due to slowing demand. At its 2021 unveiling, Ford CEO Jim Farley calling the truck, quote, a test for adoption for electric vehicles in America. The slowdown, an ominous sign for President Biden's 2030 EV goals. Your team coverage starts right now with AMH in Washington, Ed Ludlow in San Francisco. Ed, some difficult numbers from Ford.
Yeah, and the narrative from Ford is that they are matching production to what is there in terms of consumer demand. What that looks like in real terms is that they're currently building around 3,200 F-150 Lightnings a week. Next year, they'll build 1,600. The average selling price right now for an F-150 Lightning across the variants that are available in the market is about $65,000 US. And it's interesting. Look at Tesla. I think it's down around 2%. Rivian down around 4%. You know, they also have pickups with much higher average selling prices. Cybertruck, there's a lot of fanfare right now, but the base model that's just under 61K doesn't come to market until 2025, which kind of speaks to this idea that the early adopter that will pay the higher average selling price may have been and gone.
Anne-Marie, where does this leave the president's goals?
Well, Jonathan, this goes back to April when the President, the Biden administration, along with the EPA, proposed these rules that were so tough on tailpipe emissions that basically would mean that every automaker would have to sell 2 out of every 3 of their cars being EVs by 2032. The issue is the demand doesn't seem to be there right now. And just a few weeks ago, we heard from about 4,000 dealerships across from the United States penning a letter to President Biden. And they're saying they're agnostic, Mr. President. We just want to be able to sell cars. But we have to be able to make sure that the customer demand is there. And they're not seeing that at the moment with EVs past what Ed called early adopters. Quote, with each passing day, it becomes more apparent that this attempted electric vehicle mandate is unrealistic based on current and forecasted customer demand, Jonathan.
We're pushing these automakers into a corner, Ed. The demand's not there. Are we finding out that consumers don't really want EVs, they just want Teslas?
A question that I have, and we're actually going to speak to the White House later on the show, Jonathan, is what from the Inflation Reduction Act is currently reducing inflation? In other words, did what is set out in the Inflation Reduction Act in the context of consumer EV benefit actually do anything? You know, what's worrying is that in the month of November, F-150 Lightning had its best ever month. Sales were down sharply in the third quarter, but that was a supply issue where they had shut down production. So what is it that they're seeing next year in the consumer that we're not seeing? What is it that's caused this sharp reaction? And, we are backing them into a corner, but clearly they're acting proactively based on something they're worried about into 24.
Anne-Marie, you get the final word, please.
Well, when it talks about what's going on with the consumer, if you read through this letter, what the auto dealers are talking about is there's still a number of consumers that are concerned about range, about making sure that they have accessibility to be able to charge these types of vehicles. So as you have this, what they're calling an EV mandate, you also have a push from the administration to make sure that there's charging stations. And if they're not moving in parallel with each other at the same pace, it's going to be very challenging.
Range anxiety is real. It is real. Anne-Marie, thank you. Ed Ludlow on the latest big reality check for the EV market from Ford overnight. This is the reality check, if you want to call it that, from Secretary Yellen this morning, communicating through a Wall Street Journal event. She sees no reason inflation shouldn't gradually fall to 2%. The latest reaction this morning from the administration to the CPI data of about an hour and 22 minutes ago. Since then, equities are doing OK and then pulled back. On the S&P, we're down by about 0.1% on the S&P 500. 22 minutes into the session on the Nasdaq, we're down about 0.1% also. Let's get you some sector price action. Here's Abby.
It may be a small decline for the S&P 500, John, but it is broad-based from a sector standpoint. Most sectors for the S&P 500 are lower at this point, 8 of 11 to be precise. To the upside, materials, financials, and industrials hanging on to small gains. Then we have the rest of the sectors down not so much until we get to communication services, down about 0.5%, utilities down about 0.7%, energy down 1.5%. In fact, let's hone in a little bit more on energy, that sector. It is in the month of December down 4.1%, heading to a third down month in a row, matching the longest losing streak going back to October of 2020. This, of course, today we have oil, WTI back below $70 per barrel. Those OPEC plus production cuts not just getting the job done for oil.
Down 3%. Abby, thanks for that. Back in the 60s, a break of 69 just a second ago on WTI, 68.99 for a second or so. On Brent, 73.70, down 3% there as well. Coming up on this programme, the trading diary, a week full of economic data and central bank decisions. A sneak peek of that calendar up next. Close to 26 minutes into the session, snapping a two-day winning streak on the S&P. For now, let's see if it sticks. We're pulling back 0.1% on the S&P 500. That's the price action. Here's the trading diary. A sneak peek of the calendar for the week ahead. The US Treasury selling $21 billion in 30-year bonds at 1 p.m. Eastern. Wednesday, PPI numbers in the morning. In the afternoon, a Fed rate decision, forecasts, and Chairman Powell news conference. Thursday is the ECB's turn, along with the Bank of England, and we get US retail sales. The next 2 days, incredibly busy for this market. From New York City, that does it for me this morning. Thank you very much for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.